thanks everyone for listening to the presentation. It's quite a broad topic, and I think the one thing we can say for sure is that no one knows what's going to happen. And I think that's why I've always heard investing best described as a probability business. Now, at Allan Gray, we bottom-up investors, but we do think a lot about, and we definitely want to be on the right side of long-term trends, and both on the extremes of valuation and economic variables. And the sort of scenario I'm going to be focusing on today is increased inflation. Now, we all know there's been a massive increase in monetary supply in the world through quantitative easing that dwarfs the response to the great financial crisis. In fact, if we just put the Fed buying into perspective, you could buy the whole of British American Tobacco and Richemont every 37 days with what the Fed is spending in the market. Now, that has been combined for the first time with fiscal spending, and so what I kind of see is a higher chance of inflation coming through into the future. Now, this increased inflation, particularly in the developed world, will show through in higher nominal dollar commodity prices, and this will be exacerbated by ESG policies. And what I mean by exacerbated by ESG policies, well, it's raising the cost of capital for resources as well as capital-intensive industries. South Africa, I think, will be temporarily buffered by the higher commodity prices. And I see from the Molagela's presentation that he'll be talking about that as well. Now, in South Africa, we're used to inflation, and I don't think a lot of people put enough thought in. We have inflation in South Africa because we're expecting inflation. Now, that's very different from the rest of the world. If you've been managing money in the developed markets, you've really only been managing money for 2 decades in a disinflationary, declining interest rate environment. And I've in fact heard this best described by Russell Napier, a financial economist, and he said when they asked him, if you believe in inflation, what are you sort of advising your developed world clients to do? And what he said was, I think you should fire all your portfolio managers and replace them with Brazilians. And what did he mean by that? He meant, well, Brazilians have actually been in countries, just like South Africa, where we've had inflation, we've had currency crises. We worry about our governments. We worry about our country. So the one big risk from the scenario I sketched is your fund manager may not know how to manage money in a different environment. We potentially also face stagflation. And what I mean by stagflation is when we have low economic growth plus high inflation. That's really the worst kind of world that we want to be in. And we kind of look at history. When inflation goes up, we expect interest rates to go up. But what has happened is governments in history have applied financial repression. What do we mean by financial repression? Well, there you have governments and official agencies trying to keep interest rates low. How do you do this? You do this by yield curve control. In other words, central banks just go and buy tons and tons of long bonds to try to keep the interest rates lower. Or we have legislative changes. And in South Africa, we would call that prescribed assets. So that's when the government says, listen, if you're a pension fund, you have to buy this much government debt. If you're a bank, if you're an insurer, you have to hold a minimum of government debt on your balance sheets. And in that way, they try to keep interest rates down. But I think it should be obvious to everyone that the more and more money printing you have, the more and more you fund the government becomes bigger relative to the economy over time, and it doesn't pay any price for that. And I think, especially as South Africans, we know the risks that are involved when a government becomes too big relative to the economy. Productivity tends to decline quite significantly. Now, with this printing of money, and I think we've seen this over long periods of time, in times when money is being printed, people tend to lose faith. There's something wrong. How come I have to work for 10 hours to earn my salary, but someone can just print money in a few minutes? It just doesn't kind of make sense to people. So we have this growing inequality in the world and in South Africa, where people who own assets are getting wealthier, and people who don't own assets are getting poorer as a result of these quantitative easing policies. So what I predict in the future is there's going to be far more focus on redistribution in politics, and there's going to be far more focus on rules that favor labor over capital. Now, you might say, how does this pertain to South Africa? We already have a very redistributive economy, but I think it gives the government cover when they say, oh, well, we're doing this in America, we're doing this in Europe. Let's introduce basic income grant. Let's introduce further social grants and to increase that redistribution. I guess the thing that worries me most when I think about the risks of the scenario I've set out is every time I've gone and read up a lot about inflation recently. I mean, we don't know if it's going to happen, but every big inflationary episode has been sort of associated with social unrest, social instability. Whether it's 1920s in Germany, you can go back and look through history, the 60s and the 70s in the US. So again, I think this speaks to greater redistributive policies, and again, more sort of rules and legislation that favor labor over capital. Now, I mentioned ESG, and I think obviously it's a massive trend, and I think it kind of reinforces all these trends. And that's why I meant by the title of my presentation, A More Divided World. People, when they think about ESG, focus a lot on the E, right? Because that's an easy thing. You can see it on the TV, you switch it on. But I think the S, social, and the G, governance, are going to become a lot bigger as we go forward. And within G, governance is not just looking at the boards of companies. I think it's going to become particularly more focused on politics. Now, unfortunately, we had to send in the topics of our presentations many, many months ago, so it's before what's happened in China over the last month. But one of the things was going to say the world is going to become completely and more polarized. You're either going to be part of the West or with the US, or you're going to be part of China. I think I know which side South Africa is going to choose. I'm not sure it's the right one, but I think the world is going to be increasingly polarized. Now, why is this important for South African equity investors? Well, it's something we've been talking about for a number of years. We haven't been proven correct yet. South African equities has a massive direct exposure to China. And what do we mean by that? Well, the big five shares on Naspers Process, Richemont, BHP, Anglos, they are directly exposed to South Africa, either through being in China like Naspers, or through the commodities they sell to them. And then, remember, we are indirectly exposed to China on quite a long way because they are the people who buy the commodities we sell, the iron ore, the coal, the PGM metals. That allows us to run a trade surplus. It allows us to keep spending in the economy. Now, that could reverse at any time. And what's particularly interesting for me when you look around the world, and the investment team, Allan Gray, given the events recently, we've been spending a lot of time thinking about China and what's changed, and is it a permanent change? Speaking to our colleagues at Orbis in Hong Kong, which I guess is China these days, and you can have a look. There are various big Australian superannuation funds which have now excluded Chinese assets from what their asset managers are allowed to invest in. And if we look in the US, there's quite a push for companies like MSCI, et cetera, to exclude Chinese equities from their indices, because many passive funds follow those equities. So that's very interesting. We don't know if it's going to happen, but I do think this has a direct effect on the stocks in many of our portfolios. So what can we do about this? Right? I've sketched out, what could happen, what are the risks, like what can we do in the portfolio, particularly if we're not sure what's going to happen. Now, my colleague Rory later will be talking about some specific South African shares, but what we can do, especially in our balanced portfolios, is tilt the portfolio, right? Tilt it towards the scenario I've sketched out and the probability that it happens. But I do want to point out something, and I hope it's clear to everyone, that if it's obvious that there's a risk in the market to all the market participants, it's going to be very expensive to hedge because everyone knows about it already. So when I think about how our portfolios are positioned, including the offshore portion of the portfolio, I think it's important to think of two other things. The other thing is, one, what has worked since the GFC, and remember that's almost 12, 13 years ago, may not be what works in the future. Right? So a lot of people, and I try to find the study with the stats, but I think it's less than 15% of people who manage money today have ever managed money before the GFC. And that comes back to my earlier thing. The risk might be that your fund manager just doesn't know. All they've been doing is interest rates go down, inflation rate goes down, the Fed has your back, you've never managed money in a different environment. The other thing, if we look back at history, is you have these very big changes in leadership that tend to last a number of years. So you only have to make a few big decisions. And what do I mean by that? Well, we went from the Nifty 50 shares, then it was commodities, then you had to go from commodities to Japan, from Japan to emerging markets, from emerging markets to US tech, then into financial stocks and banks, and then what I would call the last 6 or 7 years, the e-commerce and IT disruptor stocks. And you only really had to make 6 or 7 decisions in an investment career spanning decades, and you would have been correct. Right, so that's all nice, Duncan. What do we do about it now in the portfolios? One, I think active management is going to make a big comeback against passive, right? Why do I say that? Because I think in the scenario I sketched, you can't be running a benchmark cognizant portfolio the way people have over the last number of years, and you can't look like everyone else. The other thing is, we want very little or no exposure to offshore sovereign government bonds. So we have virtually zero exposure to any developed world long bond, and at the same time, because of quantitative easing, the spreads, in other words, the interest rate you pay on a risky loan over what you pay to lend to the US government, they've been compressed to almost the lowest in history. So, we think the portfolio must be actively managed. We don't want exposure to long government bonds or high yield bonds. And then we need to think about, well, how do we gain exposure to this sort of change in leadership, whether it's the unintended consequences of quantitative easing, whether it's ESG, whether it's the energy transition. Like, how do we think about this? So, as an example, I would be over the next decade underweight the technology and the disruptor stocks that have been so strong over the last 10 years. Many people forget Facebook, Alphabet. These companies didn't even exist when their last IT bubble happened in the year 2000, right? And look where they are today. So we don't even know who the winners are going to be in the next 10 years. I think a portfolio should be long suppliers and producers of metals that are used in the energy transition. And we have written quite a lot about why Glencore fits this, we think, very, very nicely. I think you also need exposure to precious metals and precious metal supplies. And when we don't know, and as I mentioned, if people know a risk, it's already in the price. But maybe some of the gold and the platinum shares are actually relatively not such expensive options on the world I have sketched out there. It's very interesting if you look at the long work Bank of America did on how to protect yourself against inflation. Interestingly enough, the number one way to protect yourself was to own platinum. That doesn't mean it could happen in the future, but it is something to think about. I think the other thing you can do is, if you're a bottom-up manager, is look for very, very specific things that can enforce an investment case that don't rely on all these big things. And the example I use here is the move to omni-channel retailing. So if you look at a lot of the department stores or retailers offshore, they've massively underperformed. And then all of a sudden, one day, people wake up and they have more online sales than offline sales, and they have only a good store base left, and all of a sudden they re-rated massively. Now, just use an example of bottom-up research. I think something like that could be Country Road within Woolworths. When people speak about Woolworths, they only speak about the clothing business and the food business. No one ever speaks about this business that generates far more than R1 billion of operating profit and is making almost 40% of its sales online. So I think Woolworths own a potential omni-channel retailer that could be very valuable. The other one could be, well, if you are worried about redistributive property policies, how can you protect yourself in South Africa other than, I guess, taking your money offshore? Well, you could own PEP, right? So the more there's a basic income grant, the more social grants increase, a whole chunk of that just finds its way into the top line of Pepcore. So I hope that gives you some idea about how we think about hedging it in South Africa. Now, what about this big China risk? It's something, if you ask me, what do I worry about by far the most in the portfolios? And I think the events of the last month and a half have really brought that right to the core for South African managers. So you don't have to own those big 5 diversified companies. Well, what about British American Tobacco? Not only is British American Tobacco cheap, gives a yield very high in pounds, but there's one very important thing about BAT. It has zero China exposure. And why does it have zero China exposure? Because its assets were nationalized by the Chinese government, I think, in the 70s. So there's a nice way we start changing the risk. And then if we look, well, why don't I take some of my money that's in process and Naspers, and why don't I move some of it into AB InBev, the biggest brewer in the world? AB InBev has been a terrible investment since it had the big takeouts of SAB Miller. So there's another way where we can start changing this reliance on China. And I do think then, when we think about the ESG, it's not that similar. It's not that similar or not that easy when we come to China. We only have to look at the experiences of H&M, of Nike. When they try to speak up about human rights abuses in China, boom, all their stores are closed. There's sort of vandalizing of the stores. So this is a very difficult thing that companies are going to have to navigate. So what about the ESG, just to finish off with? I think the one thing is, everyone's going to have to think a lot harder about the absolute size of their Naspers and process positions in their portfolio. And then I think there could be a lot of things, unintended consequences of ESG. We only have to look at the performance of thermal coal over the last while. No one wants to be in coal, but the thermal coal price has gone up massively. And we saw when it was very cold in Germany, well, what did the Germans have to do? Well, they didn't have enough coal for the base load of their electricity, and they had to go and get energy from Mr. Putin. Now, what is worse, having a little bit more coal or making Germany subservient to Russia? I think these trade-offs are going to be quite complicated, but I think the one commodity that could do really well here is oil, right? So people just don't want to own oil, but I think, that trying to push demand destruction and supply destruction, oil could surprise on the upside, just like it did on the downside. So why not have a little bit of Sasol in your portfolio? And we've done a lot of work at Allan. We think the best way to sort of benefit from ESG is to not buy the best ESG companies, because everyone knows that. It's to buy the ESG companies that are improving the most. So if you find ones that are improving relative to the past, they do better. And maybe just to finish off with, and this is from me, something personally, not Allan Gray, I do think in the scenario I sketched, it's going to be very important to have independent thinking. Independent thinking is kind of being crushed in the world, and if you're going to need to be different, you're going to have to think independently of the rest.